So in yesterday's session, we did investment center. And we talked about the two performance measure for investment center manager, that when you're going to appraise the performance for an investment center manager, that how well he has actually performed, we are going to do on the basis of return on capital employed. Okay. And as well as one is basically return on capital employed and the other one is residual income. Okay, talking more about return on capital employed, there was one last thing left. Okay, we talked about the operating profit margin. We talked about the operating profit margin, and operating profit margin, what is the formula for operating profit margin? Is operating profit over sales. And what is operating profit? Operating profit is profit before interest and tax. Okay, let me revise. Sales less production cost, what you get is gross profit, and after deducting all total cost, production as well as the non-production cost, what you get is profit before interest and tax, also known as your operating profit. So what does this percentage tells you? That how successful a profit center manager is, that what is the profit as a percentage of sales. More the profit as a percentage of sales actually shows that your cost is less. So less the cost, more the profit is. Yeah. So if you get a sale of 100, right, and in the end you get a profit of 30, that means 70 is your cost. 70 is your cost. And if you try to reduce the cost, definitely the profit would go up. So this was your profit, and the percentage here would be 30%. So that's the operating profit. And we also read that what is return on capital employed. What is profit or return as a percentage of your capital employed. Okay, this another thing here that we are going to study is asset turnover. Okay, what is asset turnover? Asset turnover is sales over capital employed. We told you the capital employed is your investment, right? And there were two formulas that how to calculate the capital employed. Okay, one formula number one was equity plus non-current liability, and the formula number two is that of the net assets, which is basically total assets less current liabilities. We did this. If you don't know, you can check the previous lectures. So sales over capital employed. What does asset turnover tell me? Because there are two important things that we are, in addition to ROCE, that has got a relation to ROCE, which is operating profit margin and asset turnover. Why there's a relationship between two is that why there's a relationship between two is that return on capital employed is basically product of operating profit margin, operating profit margin into asset turnover. Now we need to know what is asset turnover. Okay, if more is the sale out of the investment, because why do you do the investment? Okay, why you've got the shareholder fund, you've got the bank loans, and later you convert them in buying the current assets, yeah, non-current assets, and then you take some liabilities, your short-term liabilities you have to pay to the suppliers. Why are you doing business? Just to generate sales. More the sales, less the cost, more the profit will ultimately be, and more will be the return on investment. So easy. So what does this figure, this ratio calculates? It calculates actually sales is how many times of the capital employed. For example, if 2 lakh is the sales generated, let me open up the calculator just to show you. If 2 lakh is the sale, right, if 2 lakh is the sale and 1 lakh is your investment, now tell me sale is how many times the investment? Yes guys, sale is how many times the investment? 2 lakh divided by 1 lakh. Out of the sale of 1 lakh, investment of 1 lakh, you actually generated sale of 2 lakhs. So that actually means sale is two times of investment. So more, definitely more the revenue, more the profit is, right? So more times the sale is in proportion to your investment that you're putting into the business, definitely more profitable would you be. So the two measures that actually measure the return on investment, there are actually two things that would actually measure the return on investment. One of them is basically operating profit margin. More the profit would be, definitely more the investment would be, more the return on the investment. And more times the sale is that of the investment, definitely more will be the return on investment. So both are measures of return on capital employed. If you know the formula of return on capital employed, it is PBIT divided by capital employed. And also, if you know the formula for operating profit, it is operating profit divided by sales. And now if you know the formula of asset turnover, it is sales over capital employed. So how ROC is actually a product of capital employed, because this and this will be cancelled. So ultimately, ROC is what? It is operating profit over capital employed. And operating profit is same as profit before interest and tax. So 5 lakh, if I have sales of 5 lakh, right? $5, okay? Out of a dollar of $1 lakh, that means my sale is 5 times. And more the time your sale is to investment, definitely more will be your return on capital employed. So have a look at, and more the profit is percentage of sale, definitely less would be the cost and more would be the return on capital employed. So actually return on capital employed is product of operating profit margin into asset turnover. This one example here, see, have a look at this example here. And if you are able to solve, an investment center has recorded the following information. This measure could only be the responsibility of an investment center manager who is end-to-end responsible for everything. He is responsible for cost, he is responsible for revenue. So definitely he is responsible to generate profit over investment. Okay. And his performance would show that what profit he generates in relation to the investment. So definitely he is basically responsible for operating profit over sales, operating profit, and also is responsible for to maximize the sales over investment and to maximize the asset turnover. Because if both of these things would be maximized automatically, which is return on investment, profit over sales would be maximized at the same time. So this is operating profit margin into asset turnover is basically what it is, return on capital employed. So here you're given the profit for 2005 and 2006. One investment center has reported a profit of 180,000 in 2005 and profit of 234,000 in 2006. And the investment in 2005, which is capital employed, is 1,000 in 2005 and 1,200 in 2006. Okay, and sales data is also given. Sales, there you've earned 2 million sales in 2005 and 22.4 million sales in 2006. The performance, now here you want to assess the performance of the investment center. Out of the given data, I can actually calculate return on investment, operating profit margin, as well as the asset turnover. And I can actually correlate the figures and make it equal to ROCE. That's what has been done in this illustration. So starting from return on capital employed, the formula is profit over investment, right? What is your profit over capital employed? Profit for 2005, it is 180,000. Can you help me do the calculations? 180,000 and the investment is 1 million into 100. What is the return on capital employed? That's 18%. Now tell me, what is the return on capital employed in 2006, whether it has improved or not. So let me first calculate it. In 2006, the profit actually went up and it was 234,000. And what was the investment? Investment also went up, 1,200,000 it was, into 100. So what is return on investment? Here it is 19.5. I told you if you had calculated operating profit and asset turnover, you take the product of it and it will be equal to ROC. I can actually do that. So here's the profit. Profit is 180 divided by, okay, if you leave that thousands, you can do that as well. That would make it easier. So 180 is the profit divided by 2000 is the sales. So what is basically operating profit margin? So in 2005 it was 9%. Okay, in 2005 it was 9%. And now what is the profit margin in 2006? If 100% is the sales, mean 9% is your profit. So the rest of 100 minus 9, the rest of that would be your cost. Rest of that would be your cost. That means 91% is your cost, right? So 2, 3, 4. So that's the profit figure. Profit over sales. That's the sales figure divided by 2400 into 100. So it is 9.75. Actually, profit went up. From 9%, it got to 9.75%. There is an increase in profit of current figure minus base figure. Actually, there was an increase in profit of 8.3% increase in the profit, right? And now about asset turnover. Asset is what? How many times the capital employed? So put sales in the numerator. That the formula is sales over capital employed. So sales over capital employed. 2000 divided by 1000. So asset turnover in 2005 was 2 times. Then asset turnover 20 sales over capital employed. 2400 divided by 1200. So asset turnover was the same in both the years. So why ROCE went up from 8% to 19.5%? Because the net profit margin actually went from 9% to 9.75%. So actually maybe we controlled our costs, so our profit went up, but the sales to the in relation to the investment has remained the same. It was actually 2 times we are earning out of our investment. Here again, it's twice. Here 1200 into 2, that makes 2400, right? So we are earning twice the time of the capital employed in both the years. So it has remained the same, but still the return on investment in 2006 is more. That is because of the increase in the profit. So both, whether you increase the times, for example, if time had increased from 2 to 3, if number of times had increased from 2 to 3, like the sales would have been, for example, in 2006, it was 3600. If the sales was 3600 out of 1200, it would have been 3 times here. And for example, the net profit sales were 3 times and net profit margin was, for example, the same, 9.75. Now tell me what would be the return on capital employed in that case. So that would be 9.75 into 3. So it would be 29.25 in that case. Okay. So both the asset turnover and operating profit margin, if both the value percentage ratios would increase, definitely automatically it would increase the return on investment that you are generating. Okay. So that's about it. The next thing I wanted to discuss was just a minute. Okay. Next thing in this session that we are going to discuss is accounting for management. It relates to your MA1. It relates to your MA2, and it also relates to your FMA syllabus, which is F2. Okay, you can read the topic, the same topic from all the books, starting from MA1 and then from MA2, and you have a fair chance to clear your concepts since you can use 3 textbooks for one topic. Okay, and definitely it would be written in very basic somewhere in MA1 and then in MA2 as well. Okay, if I show you the book for MA2, the same I refer to that's the MA2 book I did this question from. And in the MA2, in the same chapter, that there you will find the management information. Okay, whatever we're going to discuss here, it is available in this. So it's a very good chance for you to consult to your textbooks, refer to 3 textbooks and clear your topic and clear your concepts. Okay, yeah, that's the management information. That basically is chapter number 1 in MA2, and you can also refer to MA2 and the same topic you can do that. Okay, I'll tell you what we haven't covered in high-low method. We haven't covered what is F2 level high-low method. The rest MA2, MA1 we have already covered that. So don't try to read high-low method from F2. I will just tell you which topic you can read from all the books. So whatever we have done up till now, except for high-low method, you can read from all textbooks and clear your concepts. Okay. Okay. Now, why actually management need information? Okay. So first of all, starting from the primary objective of any profit-seeking organization, I told you the primary goal for any, there are two types of organization. One could be profit-seeking and the other one could be non-profitable organization like charity. Yeah. So in profit-seeking organization, it could be a manufacturing organization like Pepsi, Coca-Cola, or it could be a service organization like Emirates, any hospital, any school. Okay, it could be a public sector organization controlled by the government, like government hospital, government school. Okay, so for all profit-seeking organization, I'm not talking about the not-for-profit organization because they don't have the profit objective. They are charitable organization. Their aim is to serve the purpose, whether it's education, whether it's some earthquake rehabilitation, whether it's for poverty. They are serving for some cause, right? So they are whatever they perform operations they do, the aim is not to make profit out of it. Okay, that lies in case of a not for profit organization, which are basically known as your charitable organizations. So other than that, whether it's a manufacturing organization or it's a service organization, the primary goal is basically shareholder wealth maximization. The primary goal for any profit seeking organization is to earn profit. And how they would maximize shareholder return? Definitely by maximizing the profit, by increasing the revenue, by decreasing the cost, by increasing the market share, by improving the quality, innovation, bringing in innovative products. That's how they will be able to maximize the shareholder wealth. So primary aim, because shareholder are the investors into the company and they have hired the management who would definitely will maximize their wealth. So how would they be made accountable to the shareholders? Definitely they have the shareholder have given them certain return. They're expecting certain returns. So as per their return, they set their goals and their objectives. So goal, what is a goal? Actually, goal is basically very generic. It's a long term, it's very generic, right? There's a difference between goal and objective. First of all, out of the vision, and then comes the mission. We'll talk about what is the mission. We've already touched it a little bit. Again, we'll go through here. From the goal, there comes the objective. Goals and objective have been used interchangeably. Okay, they are used or alternate to each other, but there are differences. Now today we're going to discuss about the differences. There's an acronym used to define objectives, which is SMART. Okay, goals are very generic and very long term. For example, shareholder wealth maximization is one example, or I want to be an educated person. Okay, how you would do that? Either by choosing, either by being a doctor, by being a teacher, by being a lawyer. There's several options. So how are you going to achieve that goal? It's a generic, it's not very specific to how you want to be an educated person. So same like that, the shareholder wealth maximization is a goal. It's very generic. How you would achieve that goal? There are multiple ways to do that. By increasing revenues, by decreasing your cost, or by increasing your market share, right? Or by improving your quality. There are multiple ways how you would just earn that minimum level of investment for the shareholders. How you would maximize the shareholder wealth, more the profit, more the dividends would be. And basically the appreciation in the share price and as well as the dividend growth basically is what is giving the maximizing the wealth of the shareholder, and all is dependent upon less the cost, more the revenue, more the profit, then only they would be able to get more dividends. Dividend is the return the shareholder gets out of their investment, because that's a kind of a profit sharing. Out of profit, what is the share we are giving to the investors, back to the investors, right? So definitely, if we are earning good profits, the dividends would be good for them. So, but how to increase that? It was a generic thing, and it's a long term. How we're going to achieve that in a short term? Probably, I told you the objective. The three type of objectives. One could be the strategic goals, other was the tactical goals, and then the operational goals. And we talked about the time frame for that. Here the time frame for long term is 3-5, could be for 3-5-7 years. 1-3 is called your tactical goals, tactical objectives, and operational objectives would be less than 1 year. Like what you want to achieve in less than 1 year, how many sales units, how many production costs in less than 1 year, like in a month or so. It could be daily, weekly, monthly. So it would be less than 1 year would be your operational goal. So depending on the level of the organization, so would be the objectives like that. So goal was very long term. Okay, it didn't tell you that how you would increase that goal, just like we talked about, by increasing revenue, decreasing cost, increasing market share, by improving quality, or by bringing innovative product. So objective, but objective is going to be very specific. S correspond to specific. Then it should be something which is quantifiable. It should be something which is quantifiable, because only a quantifiable objective would be measurable. There's a saying that what gets measured, get done. If you will be given a target and then they're going to measure your performance, then only you would take it seriously, because you know that your evaluation will they'll be calculating, they'll be assessing your performance, and then only you will be getting the rewards out of it. So objective is something which is quantifiable. How we could have measured the shareholder wealth maximization? Yeah, that was a goal. It wasn't measurable. So unless it's not measurable and quantifiable, it will remain a goal and it won't become an objective. So I take an example. How I'm going to increase the revenue? Okay, I'm writing it like here. Increase revenue by, okay, next thing is by how much percent I want to increase revenue. That would actually make it quantifiable. Okay, increase revenue. My target is to increase revenue by 15% in 3 years. In 3 years. Now I'm going to ask you, tell me whether it's goal or it's objective. Okay, it has to be specific, it has to be measurable, it has to be it has to be attainable, or it has to be result oriented. What do I mean by attainable? Okay, if somebody tell you go and climb Mount Everest or go and climb K2 in like 1 day, is it possible? Definitely not. So that was a target which wasn't attainable, means it wasn't realistic. So if my manager tell me to increase my revenue or to at least sell 10 units a day, or at least whatever in a month, sell this unit in a month, and in 3 months do this amount of sale, and in 1 year do this amount of sale. Okay, whatever is the time period, I need to know that that goal, whatever the manager is giving to me, it is attainable. Then only it will become my objective. So another objective feature of a good objective is it has to be attainable, means it has to be realistic. And another thing is R for it has to be result oriented. I told you whatever is quantifiable, definitely it would be measured, right? So there has to be some end. Okay, after 3 years it would be measured anyways. Okay, and another important, very important feature, T is for time bounded. T is for time bounded. Okay, if they tell me that climb up Mount Everest and they don't tell me the time, okay, if your manager tell you to do a certain task and you don't know when to submit the report, definitely you would just lag on to it. Yeah, you would just go along with it, and you know there's no time limit, and definitely you will get complacent at the same time. You get lazy. Yeah, so objective is such that has got all the features. It has to be specific that how to achieve that goal, By increasing revenue. Okay, it has to be measurable. So this quantification, it actually makes it result oriented, it actually makes quantified, it actually makes it measurable. By how much percent? I need to know that. I need to clear about my objective, that what I need to achieve. And if I achieve that, I will be given some monetary reward, some bonus or something like that. It will motivate me, definitely. And if I would think that it's attainable as well, okay, if I see, yeah, it's kind of okay, increase revenue by 15%, I can do it in like 3 years, right? And the next important thing is it has to be time bounded as well. Like increase revenue by 15% in how much time? Like in 3 years. So that actually makes it time bounded. So now are you guys clear about goal and objective? What if I write here another objective, for example, decrease production cost by 10% in 1 year time. In 1 year time. Now tell me, is it a goal or an objective? Is it goal or an objective? Yes, guys?
It's subjective.
It's an objective or a goal?
Objective.
It's an objective. Why? Yes. Because I know now that how to achieve that goal, and it's specific that by decreasing production cost. By decreasing production cost as well, I can increase my profit and I can increase that goal, which is shareholder wealth maximization, right? So, and also it quantifies it as well, that by what percent? By 10%. Is it attainable? Okay. Result bounded? Yes. And it's time bounded as well, like in 1 year time. So definitely it's an objective. Definitely it's an objective. Okay. Now, I told you there's some long-term objective, there's some long-term vision statement of our senior management, right? Board of directors. Yeah. They see, maybe they're looking at the company, that how the company would be in like 30 years time. Yeah. That is going to be, vision statement is basically a very long-term kind of a thing. So then from vision statement, there comes a mission statement. There comes a mission statement, but mission statement is particularly focused upon a short term. Yeah, maybe in 8 to 10 years what a company is looking to achieve, so it can be a company's mission. But vision statement could be 30 years, could be 60 years. It's a very long term vision of your senior management. Okay. Definitely what that would be dependent upon what shareholder expectation is from the management. Okay. So mission statement of ACCA, for example, if you see is and mission statement has got a certain attributes to it. Okay. What actually is mentioned in the mission statement is basically purpose of the company. Okay. It also tells you about your customers. It also explains about what tells you information about the product, service, or what is your target market. And also it doesn't, it's just a generic statement. It doesn't give this, it's not quantifiable goal. You never in an mission statement you will find some quantification of your objective or goals. So it's going to be just telling you the purpose, what are the customer, what are the product, what are the market you're capturing, what are level of service you're giving, basically what you're there for in the market. And it will also tell you about your values and philosophy of the company, beliefs, philosophy, company's beliefs, company's values, and beliefs. Yeah. So, for example, mission statement of ACCA is, ACCA mission is to be a global leader in the profession. They want to lead globally in their profession by providing what? Opportunity and open access to people of ability wherever they are in the world. So that makes them the global leader. It's not in any particular part of the world. It's everywhere. It's a global qualification and they want to lead it globally, whatever they're doing. So it actually tells you the purpose of their existence. What is their target market? What are the product and the service they're supporting and promoting the highest ethical. Now they're telling their values now, the values and the beliefs. And what are they looking in their students to achieve? A highest ethical level, governance, and professional standards, professional standards, highest ethical standards, and advancing in the public interest. So they want to do all those things that are mentioned in the mission statement. So whatever their policies, their targets, goal would ultimately be focused upon what are the things given in the mission statement. Then only their mission would be achieved. So whatever they will be setting their targets, operational goals, long-term targets, tactical targets, so whatever that will be in line to their mission statement. Let's see another mission statement of PepsiCo: to provide consumers around the world with delicious, affordable, convenient, and complimentary food and beverages, from wholesome breakfast to healthy and fun daytime snacks and beverages to evening treats. So it pretty much sums everything that what is the company all about, okay? And there are several variety of the products that they are offering, from snacks to beverages to evening treats. So that's what it is, and around the world. So it tells you the market, yeah, that's also a multinational, right? And mission statement of Google is to organize the world's information and make it universally accessible and useful. Yeah, we are users of Google. They've got amazing products. Yeah, earlier we were saving our stuff in our flash drive or hard drive or some in our computers, even though we keep the backup, but we also are using their free products. They can go very lethal into the any market they're entering. They offer free products up to a certain limit. After that, they definitely charge subscription that actually give them the revenues, they required revenues for that. But they offer free products, like for example, are you aware of the Google Drive, right? Google Drive, I can store everything in the Google Drive, and it has got the free products such as like Google Forms. I can make free forms and then paste it anywhere just to get admissions, or just to do any inquiry, any research. They've got that Google Form. They've got Google Sheet, just like Excel spreadsheet. They've got a product Google Sheet, and everything, whatever you'll be doing, that it'll be automatically be getting saved in your Google Drive. So up to 15 GB it's free. Up to 15 GB it's free. So they want to organize, and also it has got amazing search engine. You can Google everywhere. So to organize the world information and make it universally accessible and useful. And useful, that means definitely whatever data they get, they actually convert it into information so that it becomes useful. Whether I want to search an article, so it is not in a raw data form that it doesn't give me any information. Definitely it would be useful only when it would be systematically processed into information. That's what we get from the Google. Whenever we try to do search for any topic, it would give us multiple links, yeah, in its search engine. So that's the mission of Google, right? That's the mission of Google. And the other are and also the other products are Google Classroom is amazing product. So that's about the mission statement. Now we are going to discuss about how, since you know that you'll be by the end of this you'll be a cost accountant, and F2 you would know how to become a management accountant in an organization. And definitely after you do your ACCA, maybe practically you'll be doing preparing budgets, practically you'll be working in departments calculating the cost or price, doing the inventory valuation, or the assessing the product profitability, division profitability, and at times you may be selling the selling price as well. So here I would just describe what is the purpose and role of cost accountant. Just try to think very practically that you, for example, if you would be working in the budgetary and the planning department, so this is all you'll be doing. This is all you'll be doing. So you need to know what is basically the role of cost accountant, management accountant in an organization. So what is cost accounting? The two things you will see here: cost accounting, and the other one is management accounting. Okay, so first of all, I told you recording of cost. Okay, so after that you should know how to calculate a cost of a product. We already touched it that first of all we calculate production cost, and then we calculate the non-production cost. That's how we calculate the cost of the product. And in production cost we look at the direct and indirect cost. And direct cost is basically prime cost, and indirect cost is part of production cost, but which is not directly traceable to one unit of a product or a service. That's how we calculate the cost of a product, and then we add the non-production cost as well. For example, production cost is 10 and non-production cost is 10. So that's how I calculate the cost of a product. You would be able to calculate the cost of a division as well. Yeah, maybe you're a trainee accountant working under any cost center manager, and it gives you a raw data, gives you raw information about, for example, the company bills, the material cost, the labor cost casual. Maybe you will be having to do some material working as well in there, maybe some labor activity. It gives you very raw data, like the 4 staff members, they actually work 24-hour day, and in a weekly you need to calculate what is actually the cost incurred in that particular division. And there'll be some overhead costs such as bills as well. There'll be some other staff salary, bonuses. There may be, for example, some bonuses as well, and there may be some other advertisement, some other cost, for example, advertisement cost, some distribution cost. Or so he'll provide you some set of invoices. From there you will just trace the invoice and calculate the cost of that particular division. Okay, you will just you should know the basis of calculation. Okay.